sticky inflation rate hike cycle by global central banks, firming up of crude oil prices, and a possibility of subpar monsoon back home are likely to keep overall market mood in check over the next few months. Against this backdrop, analysts feel investors will be better off staying with the large cap stocks. Rahul Arora of Nirmal Bang expects the large caps to outperform their mid and small cap peers as investors seek safety of returns. Our bias will be towards large caps since we expect 2023 to be one of risk aversion in the aftermath of the impending effect on the global economy due to incessant rate tightening by central banks. On a relative basis, large caps will outperform the mid caps this year. In the 2022-23 fiscal year, the small cap index underperformed the large cap index on the BSE by a wide margin. While the S&P BSE Sensex ended FY23 with a gain of 0.7%, the small cap mid cap indices on the BSE and BSE 500 indices lost ground. Investment-wise too, analysts suggest investors accumulate large caps after the recent corrections as valuations have become attractive. Market valuation has become quite attractive. The Nifty's 1-year forward price to earnings or PE is down to 17.3x, which is a 10-year average. However, given the multiple headwinds, we continue to suggest a tilt towards top 250 stocks in terms of market cap ranking till the overall market sentiment improves. Devarshi Vakil, deputy head of research at HDFC Securities, suggests large cap companies typically have better cash management systems that make their business more sustainable. However, it does not mean that stocks of these companies cannot undergo a correction and should be considered a safe haven bet, he said.
If we study the history of Nifty for the last 2 decades, we find that there are more than 100 changes in its constituents. There were some then considered large and established companies who are now nowhere to be seen. Apart from that, there are enough and many examples of large cap and index stocks having a bad couple of years where the stock price is halves. So we do not think that any stock should be considered a risky because of its market capitalization is relatively lower compared to large companies. Any company whose earnings are endangered due to disruption in business model or company has an unsustainable debt on balance sheet, promoters are highly leveraged or company has related party transaction or debtors which are questionable on the books, that should be considered a risky company.
So, while sticking to large cap stocks seems to be a better option for now, investors must take a hard look at the company's financials before investing their hard-earned money. With the Q4 FY23 results kicking off this week, stock-specific action is likely to continue. Domestic and global cues too will impact sentiment.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.